All right, guys, thank you for joining us for our second fund update call. As always, these replays will be posted to YouTube. We've had some pretty good attendance on YouTube, so if you can't catch it live, which a lot of people can't, the idea obviously is to watch it on YouTube and go from there. All right, today I have with me Matthew Todman, also co-founder of Theta IQ, and David Jarvis. He's the CEO and portfolio manager at Corton Capital. You met him last week. Some of you guys have been around our community know David. Let's go on, Matthew. What's going on in the markets?
Yes, so guys, thank you for joining us. As Omar saying, like wonderful outpouring of support on YouTube. We don't have a giant YouTube channel, but the percentage of people that actually viewed it versus like the percentage of followers we have, we're quite excited about that. So, we look forward to kind of continued good things to come on that front. This is the second update call. We're going to be doing these every 2 weeks. So we're going to do a little bit of recap of financial market highlights and insights over the last couple of weeks. We're going to talk to you about some administrative, good things happening in the back end in terms of account openings. Oma's going to share some stuff about that and some stats about that. Really exciting there. We can't thank the community enough for the support there. A lot of overwhelming support and demand for these types of products. Then we're going to actually go on to the fund and look at some key data there. Interesting data we have over there, guys, and we're going to delve into the fund a little bit more deeply, and then what we are looking for in the weeks ahead, right? A lot of people want to see how that's coming along, and what our key kind of catalysts that we're looking for are. Okay. So what has happened in the month of February? So February, for anyone trading their own account, everyone knows that, hey, listen, market prices have run up and run up and run up. Volatility, we'll look at a volatility chart in a couple of pages here, guys. Volatility is at all-time lows. It's like, wow, like, just when you think markets couldn't go any higher, they went a little bit higher, and then you had great earnings. A lot of things going that. So, people are generally positive from that perspective. Yeah, there's some underlying currents of uncertainty. We'll get to that in a second. But generally speaking, February has been a pretty solid month. Tomorrow's the last trading day of the month. But so far, this is a snapshot taken as at Friday end of day, looking at where the indices are as that point. Inflation in January came in higher than expected. That kind of what that did for us was it pushed out some interest rate cut expectations out a little bit. Some economists going out into Q3, some into later in Q2. Kind of did a little bit of that. Federal Reserve meetings, they could obviously they're going to take a bit of a more cautious approach. We all know all too well that untreated inflation is a disaster to the economy, and we see some countries around the world where there are examples of a hyperbole on that note, right? VIX again oscillate between a really low level. We know that VIX has like mean reversion capability or feature inside of it, but we've seen VIX largely oscillate between 13 and 15. Reached a bit of a high at 17 on Feb 13th, but guess what happened after that? We had like some amazing earnings from Nvidia, and that kind of reignited a bit of an upward rally in that kind of magnificent seven set of stocks. By and large, yeah, there are some laggards there, obviously, but yeah, that certainly reignited a little bit of a rally, and we're seeing that kind of temper off into the end of the month, right? Now, we are looking going forward. We are looking for a little bit of a spike in volatility here, right? We are option sellers because that inherently means that we are also volatility sellers, right? So we want volatility to be a bit high. We want a little bit of uncertainty in the market to pick up on yield there, and that's really important to us. And we continually on a daily basis monitor for those opportunities. Let's continue on here.
I just want to add a few things here. Okay, so the
Yeah,
Nasdaq
sure.
was quite positive. The S&P was quite positive. The Dow Jones less so. So this is a difficult trading environment, right? We've had since October 27th, since the favorable period of the year starting. We know that we incorporate seasonality into all of our trading. From October 27th to May 5th, the stock market generally does pretty well. This February has been no exception. Now, the problem with that is volatility starts going down, right? As Buffett said, when others are greedy, be fearful, and when others are fearful, be greedy. Right now, the market is greed, as we're about to see the next slide. So we really are waiting. The good thing for us is we have a lot of money constantly coming in, and we're able to average into the position, but we're also leaving a lot of unused money, just money that we're not allocating towards puts. Why? Because simply the volatility isn't there. Oftentimes it's better not to trade, because if you spend all your money and volatility is only at 13, 12, 14, 15, and then all of a sudden it spikes to 20, 25, 30, well, then you're underwater in all your positions and you don't have any capital left. Now, the good thing for us is we have a lot of capital coming in, like I said, so we're going to be able to average down, but that is the major concern right now. It's simply not a great environment to sell options in. You want to wait for a market pullback. Hopefully we get that soon. But generally speaking, March is a pretty good month. So is April and the first little bit of February. That doesn't mean there can't be a pullback in between, because as we know from seasonality, February is the least favorable period of the strong period. And we didn't see a pullback. So hopefully we see a pullback maybe in the little beginning of March. Let's keep going, Matthew. What does the fear and greed index say?
And to that note, I mean, it is related to the fear index as well, right? As kind of stewards of this portfolio, we're not going to be pushed into getting into position just because we need to get into a position, right? Sometimes, as Omar saying, the best trade is no trade, and what? Personally, Omar and I have been burnt on that. Trying to get into a position because I think it's running away, and guess what? You get whipsawed, and we all know how that kind of story goes, right? A lot of you guys are Theta trading members or alumni of our courses. You know exactly how that goes, right? So looking here, this is a cut and paste of the fear gauge, and like you can see, we're at extreme greed, right? And
A week ago we were at extreme greed. A month ago we were at extreme greed.
we're at extreme. There's a lot of greed. There's a lot of greed.
A lot of greed, right?
And
that's reflected in the VIX number, right? The VIX is so low. You have a lot of greed out there. So you have to ask yourself, do I want to be writing puts in this environment? The answer for us is no. We are writing puts way out of the money. We're still collecting a decent amount, as you're going to see in the coming slides. But again, we're not going to be super aggressive here. We're going to wait for a pullback. It will happen at some point in time. We don't know when, because we know that the VIX is mean reverting. It's going to revert to 16. And if it's been at 12 to 15 for a few months now, the odds are it pops pretty good and we get a reversal here. And if we get a reversal here, that becomes an excellent opportunity for us to enter some positions.
Especially as there's new inflows coming in, and despite what Michael Douglas said on Wall Street, greed is not always good, right? So we want to have it back down a little bit to get some yield. All right, so again, you can check this out as well. But this is that is not to say that there are not options writing opportunities out there. Obviously, we're going to get into what positions we're getting into there in the coming slides. But again, we do have to be careful of that and make decisions appropriately, right? So what has happened, right? A lot of this had to do with one stock over the last couple of weeks.
Yeah, it totally
right?
changed the sentiment, right?
Yeah, like one stock. Can you imagine, guys? One stock changed market sentiment, because you saw, like, in very base terms, like a very, like a topping of the market in technical terms. And it's like, the market has nowhere to go. You can kind of almost see that in the trading. And then, NVIDIA says, wow, look at our results from AI. Look at the results from Gen AI chips. And wow, because those Gen AI chips, we discussed this on a coaching call previously. They are expensive chips, and upwards of $40,000 per chip, guys, right? And you multiply that across all the demand globally, it's a big number, right? And that industry is supposed to be like potentially upwards of $600 billion, right? It's a large industry. We had NVIDIA posting like awesome earnings at the top and bottom line, and that single-handedly the last couple weeks kind of turned around the market's sentiment, right? Full year revenue of $60 billion, up like 126%. As I said before, these are numbers, when you read them, you'll say, you know what, it must be a typo. It's like, well, no, that really is the number, because typically you don't see those types of period over period increases, right? So, yes.
And just to add an additional comment, from a trading perspective, it's very rare when a $1 trillion company moves 5 or 10% in a single, 10 or 20% in a single day.
In fact, David, is almost a $2 trillion company.
It is an extraordinary move. And for a lot of longtime traders, it creates a great deal of anxiety because like $1 trillion, $2 trillion companies don't typically show that kind of volatility. It would take, for example, if you're looking at the Royal Bank of Canada, which is Canada's largest market cap, you're not likely ever to see a 20% price appreciation in Royal Bank. Yes, you could see them having a 10% correction if they announce some extraordinary problem or they're the subject of some sort of extraordinary compliance breach somewhere. But in terms of just a company posting their results resulting in a 20% move is just unbelievable. And it does create anxiety for all of us who've been through a few cycles. So, I mean, the issue is, yes, we see that, VIX is down, but that doesn't mean that the volatility intraday hasn't been extraordinary, nor does it mean that there's a lot of depth. Because we're seeing some companies move, which is having an impact. So yes, the most important thing that we can do as traders or somebody who is the looking after the money that's in the fund, to make sure that we recognize the extraordinary nature of what's going on. And just to echo what Matthew and Omar are saying, the best trade is not to do a trade, and that is absolutely correct. And it takes an awful lot of courage to stand there and say, no, I'm going to wait. And we will.
Yeah, thank you, David. And the great thing with our strategy is, at least while we're waiting, we can collect some premiums, which is going to add to our gains. Now, you ask yourself, how does a company like Nvidia completely change the market's mentality? Well, the market was thinking, okay, we've got some rate cuts coming in, the economy is not doing too well. This is going to be reflected in earnings reports. Then you have a company like Nvidia that blows it out of the water, just completely kills the earnings. And it drags up this buzzword AI comes up, and then drags up companies like TSM, like AMD, and other chip manufacturers, other technology companies. Because what is the market thinking? The market thinking, well, is if this company, Nvidia, is doing this well, then surely these other companies are going to benefit from this sector, artificial intelligence, growing in chip demand. And that's exactly what happened. Nvidia came up with the reports, and all of a sudden it pulled the market ahead and has lowered VIX. We must remain patient here, wait for a bit of a pullback. In fact, Nvidia did go to about $820 and subsequently has pulled back about $50 a share. But we're going to wait for that VIX to pop up a little bit and the volatility on Nvidia to go up a bit more before we get a bit more aggressive. But you see how one company can simply just change the dynamics of the market. Let's keep going, Matthew.
Yeah, and in terms of trading around it and getting into positions, right? When that happens, assessing technical levels and where levels of support are, or basing, or even fundamentals about the company in terms of assessing what a reasonable multiple is, that becomes awfully more challenging when you have like a pickup in the stock by like 10 or 20%, right? Because we like to see things like kind of like maybe a little less than a 45-degree angle going from bottom left to top right. Now that almost never happens, right? But when you start, having almost like an exponential increase, you're like, oh well, we had a hard enough time before. How the heck do you assess that, right? Because when that happens, and you have this really steep incline, yes, your level of support, all goes all wonky. You're wondering what multiples are appropriate. You're looking for kind of industry comparisons, and if you're at the top of the industry or the largest company in the industry, you're like, well, what real competitor do you really have that's that we can benchmark against? It becomes there's a lot more judgment, a lot more professionalism required to do that type of activity, right? And that's why sometimes the best trade is no trade. We have to see, at the end of the day, the market price is, unfortunately, it's the truth, right? Because that's the price someone's willing to pay for the stock. You might have your own model, and we might have our own models. But again, at the end of the day, that closing price is the closing price, guys. All right, let's move on. All right, so Omar, why don't you tell us about demand for the Theta Alpha Fund? It's been very flattering, actually. Omar.
Yeah, first of all, I wanted to thank everyone very much for your continued support over the last number of years. We can't be more excited about building something that we truly love doing. I believe we're the only company that takes into account concentrated portfolios, selling options on those concentrated portfolios, and using seasonality. And it's really exciting to be able to put this into action. We've got over 130 accounts that are either in or are in transition. So waiting on simply transfers coming in or paperwork or signatures. And I suspect there'll be a few hundred more that are on the horizon. I have been up to my eyeballs in making calls and following up with people. So again, I can't thank you guys enough for your support. Now, the second part of the equation. So those are clients that learned about our strategy from Theta Trading and said, oh, this strategy makes complete sense. I'd love to invest. Now, the second part of growing this company is going to be meeting with investment advisors. Now, what is an investment advisor? Like if you go to your, let's say your RBC advisor, they may manage, let's say 200 million, 300 million, 400 million dollars. And then you pitch this idea to that investment advisor. That investment advisor, and we've had a lot of them. I've already met with over 40, and we're looking to get approval quite imminently with RBC, hopefully soon with IA Securities, which is Industrial Alliance, and with National Bank, because they're our back office. So what are these advisors going to do? Well, advisor has a $200 million book, says, you know what? I really like what you guys are doing. I'm going to give you 5% of my book. Well, then all of a sudden you've got $10 million coming in. And that's what will really allow us to grow this company as we grow our next phase. So we're going to continue to work on the retail clients, the friends, family, people who've taken the Theta courses, and that's been our base. But the next level of growth, what we're doing simultaneously, is getting into the advisor channel. It would be nice in the next little while, you walk into your RBC broker and say, hey, I'd like to have this fund, and it would be on their approved platform. Now, that does take a while. When you're a new company, they have to go over what you do, why you do it, how long have you been around, how much money do you manage, all those wonderful questions. But the great thing is, having now met with over 40 advisors, there is a large amount of advisors, a good chunk of advisors who say, you know what, this makes complete sense. I'm going to invest with you guys. So really excited about that, guys. And again, can't thank you enough for all your continued support. So that's what's on the horizon. The activity will not be stopping anytime soon. We are planning on growing this company exponentially over the next number of years.
Yeah, absolutely. So, and let's be specific. Like this is the RBC Dominion Securities, kind of like the full service type of branch. The same with National Bank. And there's only, there's about, I'd say there's about 12 to 15 on the street that we really want to get on that's called shelves, to say, okay, the advisor can simply offer it to their clients. And we'll be getting making significant strides to get that done over the next couple of years. But again, those three are on the horizon, hopefully for later on in Q2, and then off we go. So and that's going to benefit everyone as well, right? Everyone in it that's a unit holder. So that's really,
because it's a
really
continual, it's a continual stream of new money coming in. So whenever you have new money coming in for this particular strategy, it's a great way. What you don't want to be in this strategy is if that particular fund cannot take any new money, because then you're not able to average down as money comes in. The great thing with us is we're starting off, we have a lot of new money coming in, and we're about to crack the advisor channel soon as well and have a lot more money coming in. It's very exciting to be able to now purchase these companies. So hopefully we get a bit of a pullback here and we're able to enter some of these positions at a lower price basis. Let's keep going.
Let's take a look at the portfolio itself. So here we go. So this is our Theta Alpha portfolio, guys. We can see, here's our desired exposure on the far right column. Again, concentrated portfolio. We do have kind of a bench team as well outside of the 11 stocks, which would be constantly vetted. Now, why is it 11 and 12 and 15 stocks? Why? Because there's a whole lot of empirical evidence that academics and practitioners have come together and said, after about 12 to 15 stocks, the benefits of diversification really don't matter that much. It's not a significant impact. So from our perspective, as you guys know, I would prefer to know 15 stocks super deep. And our research head, Danielle, he does an awesome job of updating us and keeping us in the loop on literally every company almost on a daily basis. And that's an amazing piece of research. And we are able to do that on 15 stocks or so. Well, here in case 11 stocks that we're doing for the time being in the alpha portfolio. We are humans, guys. We cannot do this on 50 stocks, 100 stocks. And in fact, no human can, right? So I'd rather know 15 stocks like super deep than be super wide and know a little bit about all of them. Like that's not my cup of tea. And there's a very good reason this is the number we're sticking to. Omar, you were about to say something.
Yeah, I was going to say, it certainly makes you wonder why the average mutual fund holds 200 or 300 positions. Perhaps, David, you've been in the industry the longest. Perhaps you can enlighten us all.
What are we missing, David?
Well,
Why?
there's two growing schools of thought out here. The historic one is that um, you need to know everything that's going on in the portfolio. And yes, there's a finite amount of data absorption that any single portfolio manager can do. And I suppose in certain firms, they'll have a whole team of portfolio manager analysts, and they might be able to construct something. But the more traditional modern theory is basically saying diversification brings you closer to the average. And then if that's all you're going to do is just the average, then just buy an ETF and park it in your account. In this particular situation, um, we're accepting the higher risk of concentration, or a high risk expressed through concentration. Whereas if you were a fund manager with a couple of billion, yes, you'll end up just following it. Personally, and I've had this conversation with other portfolio managers, I say, why do you waste your time on RBC as long as you know that you're always going to own RBC? And they go, well, because I should know everything there is to know about RBC, but you're always going to own it. It's never not going to be in your portfolio. And it's the real issue is you change your weighting from the index. And what you find is that, I hate to say it, in the mutual fund industry in Canada, it's a lot about marketing. What they don't want to do is to have any surprises, and you have the potential for surprises. It goes up when you have fewer stocks. So yes, that's the trade-off. Fewer stocks, more volatility, more stocks, less volatility. And for certain people and certain portfolio managers, that is their marketing approach. And for certain clients, that is what they prefer as well.
Yeah, now my only rebuttal to that would be, okay, fine. If you want diversification, if you want 500 stocks, why go to an actively managed fund when we know that 90% don't beat the benchmark over 10 years? Why not just go to an ETF? As you
Well,
said,
you should,
yeah,
and it's not 90%, it's higher than that,
there you go.
especially in this country. There's a concept called active share. We won't get into it too much here, and that's basically how different is the portfolio from the index itself. And there's a very simple methodology for calculating, was introduced, I guess, about 15 years ago. And what you will find is that an active share, which means that 50% of the portfolio is a replication of the index, if your active share is north of 50, 60%, then basically you're being a closet indexer. And there have been legal cases. There's been attempts at class action lawsuits by people to sue some of the larger funds out there, because essentially they are running closet index funds when you measure them by active share, when you take a look at the returns. So why are you paying extraordinary fees for something that is essentially the first 90% or 80% can be replicated by an index? So really, if you wanted to be smart and efficient, take the $100, put 80 in an ETF, and then you go back to the 20 that remains. And that's where you make your individual stock selection, or what we would also call the alpha. What is the alpha? It is our ability to select stocks. It's the acceptance of risk management for concentrated positions. But yes, active share, you will find that many of the funds, it's interesting, in Canada, it's almost impossible to get mutual fund managers and and run large portfolios to actually disclose what their active share is, because they don't want people to know that they're essentially replicating the index at twice the fees.
Yeah, and that's exactly what it is. You hold so many stocks and you basically act like the index and you perform very similar to the index because you almost look exactly like the index. Then you subtract the management fees and you pretty much lose year in and year out. Again, that's what a lot of people are okay with, but it's mainly because they don't know any better. And that is why we're seeing a big movement towards the ETF space. Now, getting back to our portfolio, we're not looking to be average, as you guys know. We're looking to blow the lights out over the next number of years by taking calculated investment decisions on a small number of companies that we've thoroughly analyzed. Now, the current exposure, as you can see, there's no exposure in Nvidia because we bought back all of our puts. There's no exposure in Eli Lilly. We bought back all of our puts there as well. Little exposure in Amazon. So these numbers are going to change very drastically as more and more money comes in. As we get larger and larger, that current exposure number will start to stabilize out a bit. But that's generally speaking where the portfolio stands right now. Now let's take a look at how much did we generate so far in premiums, Matthew.
Yeah, so I mean, just to go back to this, just for like add a couple of points here. Like, Nvidia, we did have exposure. We took down the exposure because it went, the stock price shot through the roof, and our puts are left worthless. That was a good deal pickup. Now we're waiting for more opportunity to get into the stock, and we're not going to be forced into that position. The same goes with Eli Lilly. That's been it's been very good to us. But again, that also had a big uptick in price action. So we're waiting on that as well. And here's the thing: like when we're waiting on allocation, we're not gonna like say, okay, well, waiting on Eli Lilly, we're just gonna dump more into like Microsoft, for example, like and like overweight Microsoft, right? We're gonna wait till we actually have the opportunity there, right? So yeah, so we are going to have that kind of balanced approach. And sometimes, as we've said again so many times, even the same call, sometimes no trade is the best trade. So we're just going to wait out there. A prime example, I mean, pardon the pun, a prime example is Amazon, right? And Amazon, we've been looking at this at the stock and the activity around that stock for like literally a couple of weeks now. And to tell you the truth, it's we haven't had that opportunity to get into the stock at the right price we want, given the yields that we want, right? So we are going to wait. We're absolutely going to wait.
Yep.
So all right, let's continue on. Let's see how we've done. Because a lot of these, like Alphabet's kind of on track, Apple's on track, Microsoft's on track, Tesla's on track. Tesla's actually one stock where the story goes, it didn't really experience a huge uptick from that Nvidia type of relief, but it has maintained and stabilized a lot there. We've picked up some good. We've took some we've written some puts. We were signed. We've gone long. We've written calls. The story actually worked out, like that kind of 3-course meal we talked about in our courses, guys. That actually it played out pretty well for us. We're very happy there. And again, yeah. So, or anything about more you want to add there?
Yeah. So in a position like Tesla, our average was $205, right? So it's only trading at 201 today, at 202. So we're technically down, but we've collected about $11, $12 a share in premiums between puts and calls. So even though the stock is slightly below our average price, we've collected a ton of money on Tesla just from writing calls and puts, and that's exactly what the strategy is about. So we'll enter more positions as the time arises and volatility increases, but so far that's the current exposure.
Yeah.
Now let's take a look at more granular detail. How
Oh,
do we
sorry,
do?
David? Yes.
I was just going to add another comment. To be clear, this approach is active. And so even though our position in Tesla has been established at a base of 205, it's the active component of the option overlay that has been imposed that is generating the excess cash. And that is something that people should be fully aware of, that the portfolio is actively managed. It is not a passive portfolio. And if you think about it, Eli Lilly, one of the reasons why we've kind of closed out the positions, we've made some good money, is because the stock has had a pretty solid move. We're not comfortable with where the price is today and what we think could happen. And that's That's an active overlay that we have put onto the position. So this is very important. This is not a passive investment strategy. It's active. And that's what we're going to be proving to you over time, that our active nature can generate higher rates of returns than just simply being passive.
Yes, that's the idea.
Absolutely.
Absolutely. All right, so let's continue on here, guys. So, okay, a couple of things, some questions we decided to like answer in advance, guys. Is this account okay for registered funds? The answer is yes,
Yes.
it is.
That means RSPs, our ESPs, TFSAs, etc.
Yes,
Liras.
RIFs, liras, any money. So when you look at registered funds, what that really means is registered with the government as retirement money. That's generally what it means. And that can take on, like, the most popular one is your RSP, but absolutely, if there's a lira, RESP, RIF, absolutely, that's all registered money, and it is eligible for that, right? Management fee is 1.5% of the F class. Here are the fund serve codes. So, getting back to when Omar is saying we're going to get on the platforms of RBC and Industrial Alliance and National Bank, et cetera, those advisors will go and they'll punch in, okay, you know what I want to buy for my entire book, CCI 701 or 703. And like, that's kind of like the ticker symbol that they'll see on the back end. And fund serve is the system on the network that provides that, right? By virtue of us writing options and the octaneness of the fund, it is deemed as a high risk fund. Yeah, absolutely. And looking for growth investors. These are no surprises, guys, right? And again, who can buy this? Credit investors, portfolio managers, and you can get this in your SMA accounts as well. All right. Hopefully that answers some questions that we have received in the last few weeks about just common questions, guys. So what has happened in the fund? So outstanding exposure percent of AUM. So again, we're waiting on the sidelines to get some exposure here. So only about 66% has been allocated. The number of cash covered puts, guys, 27, right? That's a good chunk over, barely 4 weeks. Number of covered calls, 4. Long positions, 5, and those have been in and out kind of positions. Sometimes I think we do have we do have a few long positions right now. The exposure in stocks as a percent of AUM, so about 11% there. Okay.
So we don't hold a lot of stock right now. Right now, we're just selling puts, just trying to get into stocks. We're selling them out of the money because volatility is low. That's why if you look at only 11% of our cash has been allocated towards stocks that would be owned. Now, this number will change very drastically, and same with the first number. There are 66% as more money coming in. We're expecting a few $1 million coming in this week, and that changes the number entirely. When you have a couple more $1 million coming in on a weekly basis or bi-weekly basis, all of a sudden you're going to have to start allocating more capital, but we are going to be cautious. Now, as we have been cautious so far, and volatility is low, but we've still generated 2.5% premiums. And if you look at the actual amount of cash that we exposed, we actually generated 3.8% so far. So the market's run away a bit, but we've kept pace pretty good because we don't have money coming in yet. We aren't getting money come in. So these numbers will normalize as the portfolio becomes more and more mature. But so far, so good in terms of premium collected, considering how big of a run up the market's had and how little opportunity we've had in terms of volatility. So far, yeah, so good.
So these two metrics here are like are the most exciting metrics I believe are on the chart here, right? Because we have some unallocated cash. It's 2.5%. That's pretty good, especially when you're considering, Omar, the average days to expiration is 18, right? 18 days to expiration, right? And of the allocated cash is like 3.8% as premiums collected. So these are good stats in my opinion, especially given the trading environment, right? And meaning you're in the extreme greed portion of the market, right? Whenever whenever you hear that, it's like, okay, wow, what's going to happen next? Type of questioning. We'll take the questions at the very end because we're going to because the end of the presentation will be the question period, and we'll answer each and every of your questions as well. Okay, so what are we looking out for in terms of next few weeks of trading and managing his portfolio, right? So we are like a couple days away from March, right? And March has been seasonally strong for the past 3 years. And what happened in that fourth year ago? Well, that was COVID, and the market dipped 10% because of COVID, right? But since then, March has been positive each and every month. So we are taking especially a good note of that, right? So we might be, this is the alpha portfolio. It is a higher octane portfolio, and we might, we might be getting a little bit more aggressive there. Obviously, not going into margin or anything like that, but we will be a little bit more aggressive on our plays from that perspective.
Even going back 3 years, March and April and the first part of May traditionally are pretty good months. So this is just talking about the last 3 years have been pretty strong. But even if you go back 70 years, March is a strong month when it comes to the markets. And the markets do pretty well up until about May 5th. Sell in May and go away. And then we've had a bit of a headwind from equity price run up. So NVIDIA reported their earnings. The market got all lovey-dovey, said, yep, everything is sunshine and rainbows, which means sentiment changed, because if NVIDIA is doing well, everybody must be doing well. And that's kind of how the market thinks, short-term sighted. And that has caused the markets to run up, volatilities go down, as you know. Now, what we're anticipating coming up, and we don't know when it's going to happen, is when are we finally going to start cutting interest rates? The Federal Reserve is expected to cut interest rates in the second quarter or third quarter. We don't know exactly when, but sometime soon we're going to start seeing some interest rate cuts. Now, the stock market again is pricing this in today. It knows that there are interest rates coming up. Now, if we have surprise interest rate cuts, meaning more than expected, the market will do well. If these interest rate cuts are less than expected, expect the market to pull back a bit. And then lastly, well, we have the US election on the horizon. We don't talk about politics here at Theta because it's not a good conversation to get into. Everyone has different opinions, and that's the whole point of democracy and free speech, being able to say what's on your mind. Currently, the Republican Party is in the lead. Now, the perception is the stock market performs better under Republican presidents than it does under Democrat presidents. So it's starting to price this in as well. It's saying, well, wait a second, we're going to have a Republican president. Looks like it's going to be Donald Trump. And as a result, you know what Donald Trump did last time he was the president? Cut taxes. The stock market loved it. Now, again, we don't get into politics here. It's simply talking about the effect on the market. If the market starts getting, wind that Donald Trump is going to win and the Republicans are going to win, it's going to start taking that account the closer we get to the elections in November. Currently, if you look at some polls, Donald Trump is ahead of Joe Biden by about 6% or so on average in the polls. That's a fair lead. So the market's going to say, well, Republican president, fantastic. That's great for the market. So look for that as well. Look for some rate cuts coming in. Hopefully we get a little bit of a pullback here. Anything else to add here, Matthew, David?
Yeah, I can add a couple of things. So historically, central banks have been loath to do anything dramatic during an election year to avoid favoritism or allegations of favoritism to any particular party. Conveniently, the central banks are monitoring inflation, and they have a number of different sub-indices that they use. There's another one that's coming out, I believe, tomorrow. And yes, the central banks are in the hold pattern and are likely to stay in that pattern unless they believe that there is something that requires them an extreme urgency to act. We could see something, for example, I wouldn't be surprised if we saw a bank rate cut first in Canada as opposed to the United States. That being said, the central banks are in no hurry to cut interest rates. Originally, the first quarter, now it's kind of like the end of the second quarter. Will it happen? Most likely. It's there are certain you can using certain futures contracts that are traded, you can calculate what the expected probability of an interest rate cut is and how many times. But I have to say that everyone who's a practitioner, everyone who's been doing this for 50 years, everyone who says they're the best expert in the entire world in this, well, most of the time we're all wrong. And that's all that matters. That being said, there is some pressure. We've seen, interest rates moderate on the yield curve. We've seen mortgage rates start to come down. So the central banks are going to just be quite passive. The economy is not blowing up. They have capacity to manage a soft landing, and they're going to husband those resources as long as they can. Now the big contraposition to what Omar and Matthew are saying about the Republicans is that it's Donald Trump coming in. And so we don't know how protectionist he is likely to be. When in 2016, Chinese imports were subject to like a 3% import tax or tariff. And yet by 2017, if I've got my years correct, it was up to 20%. And so that's where they've stayed. They haven't really been moderated under Joe Biden. He's been quite tough on China, has expanded the US's presence through relationships and treaties and stuff like that. But Trump is still a wild card. That's the that's the one thing that even the Republicans know. Yeah, we think we have a handle on it. Yeah, we think we can talk to the guy, but I hate to say it, nobody really knows what he's going to say. And yes, he's on track to be the next president of the United States at this point.
It's the best they've got right now, David.
Yes.
And again, we're not
going to critique whatever, and we all have our own personal feelings about this. But yeah, like that, we have to look at in this forum. We have to look at what is the economic reality of either option.
Yeah.
That's really it.
And just so people understand what's kind of going on in the States, over 50% of Americans, Republicans and Democrats, are basically saying, why? Is there no other way that can't we have two other candidates? I mean, more people in the United States want other candidates. It's not happening at this point. Now, that's not to say something dramatic can't happen. It's not to say that Joe Biden's wife, Jill, sits him down and says, honey, it's time. Quit, resign. You're not running. And there'll be a brokered convention at the Democratic primary convention in the summer, and they'll sort it out there. And of course, listen, both of them are in their 70s, 80s. They could easily wake up with some sort of illness. They could have a minor stroke or a stroke that incapacitates them. It's going to be very uncertain. And that's fine. That's one of the reasons why we have more capital. It's why we have some cash. It's why we're going to be very opportunistic.
Yep.
Yeah. So yeah, there's things to be very excited about here. Seasonality being one of them. There's going to be some earnings out of the next chunk of time as well. Earnings that really haven't faltered all that much, even given the higher interest rate environment. Generally speaking, so we're going to be watching for that. That to me is a positive. Inflation, although it's been like literally everyone has been getting like macroeconomics 100 type of study, lecture on inflation from wherever you look at it on any news outlet. And because it's been topical for the last 2 years now, right? Maybe even more. Like everyone is talking about interest rates. We are no different because it is very, very important as investors, also as real estate owners and real estate investors. Absolutely, right? So that's very important. But it looks like that's getting curtailed at the moment. Like the sting of that is hopefully beginning to diminish a bit because we're talking about rate cuts within the next 3 to 6 months. But you do have that election, which is a bit of an uncertainty there. We do have a chart pattern that looks like it's getting to be a little bit overbought as well for a lot of stocks, right? So that in itself is a risk. And you can say that yes, looking at a chart like that is a self-fulfilling prophecy. Yeah, absolutely. We're totally aware of that as well. But again, when you see things at all-time highs for too long, well, and we see a VIX number that's really a heck of a lot lower than we'd like to see, we're looking at timing rather than anything else. So yeah, that's what we're looking at for the next little while. Things, and as we, 2 weeks ago, we thought we were talking about Nvidia as a one stock wonder that like literally changed sentiment over the last 2 weeks. Absolutely not. So you know what? We'll see what the next 2 weeks holds, and if it's as exciting as the last 2 weeks, that's great. And if it's not, it's not. And we'll make our decisions from there. All right. So just to end off, guys, here's our contact and oopsie. Here's our
Matthew, if
contact
you could leave it there
information.
for a second.
Yeah.
Guys, if anyone here is interested in investing in the fund, please shoot us an email, omar@theta-iq.com. My phone number is also attached, or omar@cortoncapital.ca. A lot of you guys have already reached out to me, and I'm reaching out to a lot of you guys. So if you are interested, let me know. I'd be love to have a conversation with you. If you have funds at different institution, you got some funds at RBC or an old pension plan somewhere, funds that you would like to be allocated in this manner, please reach out to us. We'll be more than happy to have a conversation and see how we can help out. Okay.
All right, and before we end the official type of part and get to the Q&A section, yeah, we do have a disclaimer, guys. We'll leave that on the screen for a few seconds. Let's talk about Theta trading and our that's using the license and also Coron Capital. So we leave that there, and big thank you.